In part 1 of this crypto focus series, we looked at the evolution of cryptocurrencies, the ideas that drove their creation, how crypto first found its way into India, what Bitcoin is, and how can one buy it in India. In part 2 of this series, I'll explore aspects that are less commonly discussed, the different types of crypto exchanges, other categories of coins such as stablecoins, the legal status of crypto derivatives, and what the future of crypto in India might look like. I'm your host Sandeep Rao, and with that, let's get started. That brings us to the next logical question. What types of exchanges exist in the crypto ecosystem, and where do Indian exchanges fit in? While crypto is often described as a single global market, in practice, it operates through different structures that affect custody, access, and risk. Broadly, crypto trading happens through centralized exchanges, decentralized exchanges, and over-the-counter transactions. Each serves a different purpose and each comes with distinct constraints for Indian users. Centralized exchanges are the most familiar and widely used form. These are company-run platforms that act as intermediaries between buyers and sellers, manage user accounts, match trades, and typically hold crypto assets on behalf of users. Indian exchanges as well as global platforms such as Binance fall into this category. From an Indian user's perspective, centralized exchanges are usually the first point of entry because they support Indian rupees integrated with local banking systems, handle KYC requirements, and offer customer support. The trade-off is custody. The exchange controls the private keys and the user's access depends on the exchange remaining operational, compliant, and more importantly, solvent. All major Indian exchanges today are centralized and custodial, which means users are exposed to counterparty and regulatory risk even after they have bought crypto. Then we have decentralized exchanges which operate very differently. Instead of a company sitting in the middle, trading happens through software protocols running on blockchains. Users trade directly from their own wallets without handing over custody to an intermediary. Newer frameworks such as Hyperliquid represent a more recent evolution of this model, especially for advanced trading like derivatives where custody remains with the user while execution and settlement are handled by protocol rules. In theory, decentralized exchanges reduce counterparty risk because there's no central custodian who can freeze accounts or halt withdrawals. However, they replace that risk with higher personal responsibility and technical complexity as there is no customer support or recovery mechanism if something goes wrong. For Indian users, decentralized exchanges introduce a separate and often overlooked issue: fiat access. Decentralized exchanges do not support Indian rupees or any other fiat currency. This means an Indian user cannot move money directly from a bank account to a decentralized platform. To use a decentralized exchange, one must already own crypto. In practice, this creates a forced dependency on centralized exchanges at entry and exit points. The typical flow for an Indian user is bank account to centralized exchange to wallet, wallet to decentralized exchange, and then the same path in reverse to exit. As a result, even users who prefer decentralized platforms cannot fully avoid centralized intermediaries because fiat conversion remains tightly regulated and bank dependent in India. Another important mechanism in the crypto ecosystem is the over-the-counter or OTC transactions. OTC trades are direct transactions between two parties conducted outside public exchange order books. They're commonly used for large trades where participants want to avoid price impact or when there is lack of liquidity. In crypto markets, OTC trades are sometimes facilitated by brokers or arranged privately through trusted intermediaries. However, OTC trades rely heavily on trust, offer limited transparency, and provide little to no legal protection. For most retail users, OTC transactions carry high counterparty and compliance risk and are unsuitable without strong safeguards. The larger point is that while crypto may be technically borderless, but for Indian users it is still constrained by regulatory gateways. Understanding whether an exchange is centralized, decentralized, or if you should be going through the OTC route is important. It determines who controls your assets, how you enter and exit the system, and what happens when something goes wrong. For us in India, these structural realities should matter. Next, we come to the concept of stablecoins, which are among the most widely used assets in the crypto ecosystem and often the first non-Bitcoin exposure for many users. Stablecoins are cryptocurrencies designed to maintain a stable value, typically pegged to a fiat currency such as US dollar. The most common promise made by a stablecoin is one token should be worth $1. Unlike Bitcoin or other volatile crypto assets, stablecoins aim to reduce price fluctuation, making them easier to use for trading, transfers, and temporarily holding value within the crypto system. Some stablecoins claim to be backed by reserves such as cash, treasury bills, or other financial assets held by the issuing entity. Others use more complex structures combining crypto collateral derivatives or algorithmic mechanisms to try to keep the price stable. Regardless of the design, a stablecoin only remains stable as long as the market believes that the peg can be maintained. Many investors use them to park funds while waiting for opportunities. They are also used for cross-border transfers, internal settlements between exchanges, and as collateral in lending and derivatives platforms. Because they appear price stable, stablecoins are often perceived as a safer alternative to holding volatile crypto assets. This perception, however, hides one of the most important risks in the stablecoin ecosystem, and that is depegging. A stablecoin is said to depeg when it no longer trades at its intended value. Instead of $1, it may trade at 98 cents or 90 cents or even much lower. Depegging can happen for many reasons. Loss of confidence in reserves, sudden mass redemptions, market stress, regulatory action, or failure of the underlying mechanism designed to hold the peg. In October 2025, during one of the most volatile weekends in crypto markets, liquidations across exchanges surged to $19 billion. Amid this stress, USDE briefly lost its dollar peg, with prices on Binance falling to as low as $0.65 before rebounding. While the peg was later restored, the episode demonstrated a critical point. Stability is not a guarantee. Also remember, whether it's a Bitcoin or a stablecoin, the ownership mechanics don't change. You still run the custody risk if you don't have access to the keys. So far, we have discussed spot crypto in detail, but the next question is, what about crypto derivatives? Futures and options on cryptocurrencies, and where do they fit in for us Indian users? At present, futures and options on cryptocurrencies, while being offered by some crypto exchanges accessible to Indians, operates in a regulatory grey area. This means they are neither fully regulated nor explicitly unregulated under Indian law. Unlike equity or commodity derivatives, crypto derivatives do not fall under a clear regulatory framework either governed by SEBI or RBI. This grey zone creates several important risks. The first is a lack of accountability. Investors have no assured legal records or investor protection. If a crypto platform suddenly shuts down, suffers a security breach, changes its trading rules, or refuses withdrawals, unlike regulated exchanges, there are no mandated safeguards, grievance mechanisms, or settlement guarantees. The second risk is conflict of interest. On many crypto derivative platforms, the exchange itself can act as the counterparty to the trade or the house. In such setups, platform may profit when customers lose money, creating distorted incentives. This structure is often compared to dabba trading or CFDs, contracts for difference, where the playing field is inherently tilted against the trader. Third, there is the issue of extreme leverage. Many crypto derivative platforms offer leverage of 100x or even 200x. In a market as volatile as crypto, even a small price movement can wipe out a trader's entire position within seconds. Losses at these leverage levels are not rare events. Statistically, they are very likely over time. Lastly, there are transparency concerns. Unlike regulated stock exchanges, crypto derivative platforms typically do not disclose who is on the other side of the trade, how is liquidity sourced, or how pricing and liquidations are determined. This opacity increases the risk of market manipulation, unfair liquidations, and sudden rule changes during periods of stress. In summary, trading crypto derivatives in India combines all the risks associated with crypto investing, that is volatility, custody risk, platform dependence, with additional layers of leverage, counterparty risk, and regulatory uncertainty. These products sit at the highest risk end of the crypto spectrum. I have not yet discussed the taxation implications, which introduce another set of challenges, and I will address it next. As the saying goes, nothing is more certain than death and taxes, and that certainty eventually caught up with cryptocurrencies as well. In India, the Union Budget of 2022 introduced a stringent tax framework for crypto assets through sections 115BBH and 194S. The stated intent was twofold: to discourage speculative trading and to create a visible audit trail for all digital asset transactions. The framework had three key elements. First, a flat 30% tax on all income arising from transfer of virtual digital assets, irrespective of an individual's income slab. Unlike equities or other financial instruments, crypto gains are taxed at the highest rate by default. Second, the law explicitly disallowed most deductions. Traders cannot deduct expenses such as brokerage, platform fees, internet costs, or advisory charges. More importantly, losses from one crypto trade cannot be offset against gains from another, nor can they be carried forward to future years. Only the acquisition cost of the asset is permitted as a deduction. Third, a 1% tax deducted at source (TDS) was imposed on every crypto transaction above a specific threshold effective July 1, 2022. This was designed less as a revenue measure and more as a tracking mechanism, ensuring that every transfer of a digital asset left a trail. However, when it comes to crypto derivatives, the tax position remains quite ambiguous. One school of thought among tax professionals argues that crypto futures and options should be treated like traditional stock F&O trading, taxable at individuals' applicable income slab, 5%, 20%, or 30%, with expenses allowed and losses permitted to be set off against other business income or carried forward up to 8 years. A more conservative interpretation takes the opposite view. Since crypto derivatives ultimately derive their value from a virtual digital asset, they argue that such trades should fall under Section 115BBH, attracting a flat 30% tax with no expense deductions and no loss offsetting. Now, regardless of which interpretation one adopts, the market impact of the 2022 tax announcement was immediate and severe. Within just 10 days of implementation, trading volumes on major Indian crypto exchanges reportedly collapsed by as much as 70 to 72%. Industry leaders warned that the policy had created a daunting operating environment, one that would inevitably push users, liquidity, and startups offshore. That warning proved prescient. In 2022, Business Today and Forbes reported that WazirX co-founders Nishchal Shetty and Siddharth Menon had relocated to Dubai with their families. While WazirX operations remained in Mumbai, its leadership moved to benefit from Dubai's Virtual Assets Regulatory Authority (VARA) and the absence of personal income tax. While these high-profile exits made headlines, many others did not. A growing numbers of crypto traders, founders, and the so-called Finfluencers have quietly relocated abroad. Dubai in particular has emerged as a preferred destination not only because it sits outside Indian regulatory jurisdiction, but also because its environment enables the projection of a flashy, aspirational lifestyle that plays well on social media and helps attract followers and clients for quasi-advisory services. Portugal is another country that has become an attractive destination, especially through its D7 visa program. Unsurprisingly, Indians now rank among the top 5 nationalities applying for the Portugal D7 visa, reflecting a broader trend of regulatory and tax arbitrage driven by crypto policy uncertainty at home. Speaking of influencers, there is another category worth looking at: those who never moved abroad but instead stayed in India and chose a different workaround. These are influencers who originally built their audiences in the Indian equity and derivatives markets. For years, their reach and credibility were anchored in stocks, options, and trading strategies. However, as SEBI progressively tightened regulations around investment advice, performance claims, and paid promotions, the room to monetize that audience narrowed sharply. As a result, many of these influencers faced a simple constraint: their distribution remained intact, but the set of financial products they could legally promote did not. For such influencers, crypto trading offered a convenient solution. Because cryptocurrencies and crypto exchanges largely sit outside SEBI's direct regulatory jurisdiction, influencers could continue to monetize their reach, this time through exchange partnerships, referral links, trading competitions, and promotional campaigns. This incentive shift explains a noticeable pattern. When a influencer who once focused almost exclusively on equities or derivatives suddenly begins extolling the virtues of crypto trading, faster profits, higher leverage, global markets, early adoption, you name it, it is definitely not a change in their market philosophy. More often than not, it reflects a change in what can be promoted, paid for, and amplified. So finally, what does the future of crypto regulation in India look like? And as Indian investors, what should we realistically do? Should we invest in crypto, or should we be even trading in crypto derivatives? Those are the questions which remain. On the regulatory front, I remain cautious. Not because regulation is impossible, but because crypto's structural complexity combined with the ease with which it can be misused makes light touch regulation difficult. Crypto lends itself far too easily to opacity, cross-border transfers, and regulatory arbitrage, conditions that are fertile ground for fraud and financial crime. That concern was brought up recently by a bench of Supreme Court of India justices who remarked that trading in Bitcoin in India appears to be a refined way of carrying out Hawala transactions. Now, obviously, they said it while they were hearing a case related to illegal Bitcoin trading. The language may have been blunt, but the underlying concern, I guess, was fair. There have been multiple documented instances where cryptocurrencies have been used for illegal money transfers and laundering activities. A recent investigative report by the Indian Express highlighted that in just 21 months between January 2024 and September 2025, the Ministry of Home Affairs' Indian Cybercrime Coordination Center (I4C) flagged at least 27 crypto exchanges for allegedly being used as laundering channels by cybercriminals. According to the report, an estimated of 623.63 crores siphoned from around 2,872 victims was routed through these platforms. I'll share the article in the show notes, it's well worth a read. Now, against this backdrop, expecting Dubai-style regulatory flexibility in India may not be realistic. A tighter and more clearly defined framework, stricter than what exists today, is far more likely and perhaps necessary. And that brings us to the question of participation. From an investing perspective, allocating a small portion of capital to Bitcoin purely for diversification can be reasonable, provided it is done with a clear understanding of the asset's volatility, regulatory uncertainty, and compliance obligations. Like any high-risk asset, it should remain a minor allocation, not a core holding. However, trading crypto derivatives under the current regulatory ambiguity is a very different proposition. In the absence of clear oversight, investor protection, and dispute resolution mechanisms, this is effectively playing with fire. If one is inclined to take derivative risk, it is far safer to do so through regulated markets and instruments where legal recourse and market integrity standards exist. Ideally, I hope reports of SEBI stepping in to regulate crypto exchanges materializes sometime in future. If that happens, Indian investors and traders may be able to participate in crypto markets with clarity, protection, and confidence. Until then, I would say prudence lies in staying cautious. And as they say, sometimes the smartest position in an uncertain race is to stay on the sidelines and observe. That brings me to the end of this episode on the state of cryptocurrencies in India. I hope you found the episode interesting and relevant. Do comment and let me know. Thank you for watching, and I'll see you in the next one.